recognizes the gentleman from California, Mr. Miller, for 5 minutes.
Bernanke, welcome. I want to thank you for listening to us. On your recent ruling on Basel III, you acknowledge insurance companies are very different from banks, and you postponed any negative decision on that. And I think that was a very, very wise move. You're probably aware the committee's about to consider a housing finance reform bill. And I've looked at the GSEs in the past, and I've always had a problem with the way they were fundamentally flawed. You had a hybrid situation where the private sector made all the profits and the taxpayers took all the risk, which was problematic from the beginning. You can go back to a time when you could say they performed their function very well, but they created major problems in recent years. They didn't adhere to underwriting standards. They were buying predatory loans rather than conforming loans. They were chasing the market rather than playing a countercyclical role, and that's been very problematic for us. But now we look at a situation to say, what do we do and where do we go? And if the U.S. were to end the function of the GSEs as it applies to conforming loans, would the private market be able to provide liquidity to the market? And the second part of that is, what about the time of crisis? Would investors be there to purchase mortgage-backed securities, and would interest rates tend to rise in that type of situation?
Let me first say that I agree with your analysis of GSEs, and the Fed for many years was warning about lack of capital, the implicit guarantee, the conflict between public and private motives, and so we agree that something needs to be fixed. There are a number of plans out there for reform. I think one of the key questions, I think everyone agrees that one of the key questions is what role, if any, the government should play. It seems pretty clear that the private sector should be playing more of a role than it is now. I mean, right now we have basically a government-run mortgage securitization market, but in order to protect the taxpayer and to increase efficiency, to allow for more product innovation and so on, we'd like to have more market participation. But again, the question is, what role should the government play? I don't know the answer to that, but I would say that first, that if the government does play a role, that it should be fairly compensated. That is, instead of having an implicit guarantee that it ended up having to make good on, like the FDIC or some other similar institution, it should receive some kind of insurance premium.
And on that, I think it's important, because I've argued for a position where if you're going to have a conduit, let's say, a facility to replace the GSEs, then the profits from the G fees should go into a reserve account to make sure that's solvent. And then if you have a reinsurance fee when the mortgage-backed security is sold, that should also go in a reserve account. And when the account builds up large enough over 7 or 8 years, there's no need for a government guarantee, because the reserves will be so huge based on the profits that they would turn based on what they historically have done. You wouldn't put the taxpayer at risk. But the problem we've had in the past, and I've always had a problem with it, is when you have investors investing in GSEs, the GSE at that point in time chases market share to make the investors happy. That's not their role. Their role is to be counter-cyclical. But I'm also concerned that if we make a mistake, the government's still going to be there on the hook, because they're not going to let the housing market crumble if something goes wrong. So if you don't have some entity that is self-sufficient, has huge capital to make sure that it can withstand a downturn, we're going to end up in this situation again. Maybe you can respond to that.
Well, I think that's right. Either you have to be 100% confident in the private thing you set up, or alternatively, if you think there's a scenario in which the government would come in ex post, then it might be a good idea to make sure the government gets paid appropriately ex ante, and that the rules of the game are laid out in advance.
But instead of the government, if you can create a facility that was independent of government, but established by government, let's say, that the profits were held, and they were not abused by Congress as a slush fund to be able to take money from. If you just look at the profits that GSEs are making today, if there's an entity doing that of an equivalent that was backed by some guarantee for X amount of years for them to allow the market to recover, stability to occur, and those reserves in a G fee alone, probably in 8 to 10 years, would be $800 billion minimum. If you charge a reasonable reinsurance fee on the mortgage-backed security, that's probably $200 billion in 8 to 10 years. You've got $1 trillion, which is 6 times the risk the government took in the worst downturn we've ever seen. Would that not add to market security and stability?
Well, the question there, I think, is whether this new entity could charge those G fees if you had competition. And would you be allowing private sector competition?
The goal is to allow the private sector in. The problem is they're not crowding in today. And that's what still need to provide a surety and liquidity is my concern.
That's right.
I yield back.
Time of the gentleman has expired. The chair now